So I guess we can start because it's a little bit past 3:15. So welcome everyone to the second panel on AI and regulation. Here we will be talking about the economic and financial implications of AI regulation. We are at the start of the fourth technological revolution, which is blurring the boundaries between the digital, physical, and biological worlds. And the technology we develop today is going to shape our future tomorrow. So AI can open up many opportunities to achieve the 17 sustainable goals that were set up by the UN for 2030. It can alleviate poverty, improve medicine, improve education, sustain economic growth. But as you all know, AI also carries crucial risks. So there are no more pressing issues today than how AI is being regulated. And we have put together a really interesting panel of legal experts, academics, and economists working in regulatory bodies to talk to you about these topics. So without further ado, let's start with John Frost, who is at the BIS, and he's going to kick off with a 10-minute presentation on his views on AI. And then we are going to hear from Ilja Kantorovitch, who is a postdoc at EPFL, who will talk about data privacy laws. Then we will hear from Sebastian Doerr, who is an economist at the Bank of International Settlements, who will talk about fintech and how to regulate financial institutions. Then we will hear from Mehmet Toral, who is a lawyer at Id Est Avocats, who will give us his practitioner perspective on how to regulate big tech and fintech. And we will finish with a Zoom presentation by Daniel Schnurr, who is an economist and a policy advisor at the University of Passau, who will talk a little bit about the competitive implications, the economic implications of AI regulations. So, John, the floor is yours. You have about 10 minutes.
Thanks a lot, Roxana. And hi to everyone. I'm sorry that I can't join in person. Unfortunately, I contracted COVID last week, so I'm recovering, and I was keen not to pass that on to anyone else, so I decided to take part virtually. I'm very glad that that's possible. This shows you some of the benefits that digital platforms and data can offer to us in the modern world. So I'm going to talk about particularly the role of data, and especially personal data, and some of the policy issues that raises. And I think that'll tie in nicely with what the other panelists are discussing, and what my colleague Sebastian will also be discussing about specific use of data in finance, especially around fintech, by big techs and the like. So I will quickly share my screen, bringing up my slides. I'll just check that everything is visible. Very good. All right, so I'll launch right in. So when talking about data and finance, of course, data and finance are not new. The financial sector is a particularly data-hungry sector, and qualitative and quantitative data have been at the heart of finance for centuries already. So many people refer to the famous example of the Venetian merchants who would use a telescope to see when ships were arriving, which may have an impact on prices of goods in the local market. In our own research, I've had the pleasure of poring through the now digitized ledgers of the Bank of Amsterdam, which operated in the 17th and 18th century, and is seen by some as the predecessor of modern central banks and of modern stablecoins. Those ledgers are shown on the left. And really, since the 19th century, and since the invention of the telegraph and the ability to transport data over long distances, finance has been one of the earliest adopters of new data technologies for data transmission and storage. On the right here, you can see ticker tape from the New York Stock Exchange from a purely random year, 1929. And of course, the stock exchange was an early adopter because the data can be so useful for trading, for arbitrage, for being able to find differences in prices across different exchanges for the same stocks. And to this day, the fastest data connections, new services like cloud computing and cloud storage are often being adopted by financial institutions, high-speed traders, high-frequency traders, and the like. So the broad, use and existence of data in finance, these are not at all new, but a few things have changed pretty dramatically in the past few years. And Roxana was talking about the fourth industrial revolution just now, and a lot of the changes that brings across the economy. But I think that really key for the financial sector and for what we'll be discussing today is just the quantity of data that's now available. And as people know, the cost of storing data has fallen really dramatically in the past decade alone. That's, of course, apparent if you ever go and buy a USB stick and you look how much you pay for, that amount of storage, that gigabyte of storage that used to be very expensive. We've all seen this in real time, happening that of course, local data storage is becoming cheaper. But we're also seeing a lot more adoption of cloud computing, a lot more ability to store data in the cloud and through new solutions. And the result of this is that the annual size of the global data sphere, in other words, the amount, the volume of data that has been stored at a global level, is now in the zettabytes. It seems that it's now even past the 50 zettabyte mark. And all of us, that are participating in anything online, even my giving this presentation now, being recorded through Zoom and potentially used for transmission at a later date, that adds to this global data sphere. It adds to the amount of data that are available, and this huge quantity of data, of course, offers a lot of opportunities for the use of machine learning techniques, for tapping alternative data sets that haven't yet been used for financial services, for all sorts of applications. And a lot of this is great. It's very useful. As we all know, alternative data can be extremely valuable, can give us insights that we didn't know of previously. In the financial sector, it can help price risk better. It can help identify alpha, so sources of returns for investors. It can aid in financial inclusion, and we'll hear more about that later. But of course, there are also some really big risks and concerns. In particular, there's this potential for really intrusive surveillance, particularly when we're talking about personal data. A large amount of what you see in the blue line is due to people's smartphones. So very frequently, this is information about people's individual search behaviors, their financial transactions, their interests, their likes, their social network and social graph, which can be very sensitive. And I think more broadly, we're approaching what Jeremy Bentham in the 18th century already had described. He introduced the idea of the panopticon, so a circular prison where inmates are on the outer edge and a prison guard is in the middle and can watch them at all times. All of us, to some extent, are in the panopticon, and in the middle is not a prison guard, but Apple and Google and Facebook. And of course, we're now opened up to a level of surveillance of individuals that I think is unprecedented. And that's directly linked to this accumulation of data from many different sources that have been made possible by these new technologies. So as a big picture backdrop, this is where we stand with the availability of data also for financial services. And I think that a useful way to end my intro, at least, is to talk about the different policy goals that central banks and financial regulators have when they're thinking about data issues and the use of data in finance, and the trade-offs between those policy goals. So broadly, and we've described this in work with colleagues from the World Bank, broadly you can bucket these policy goals of central banks, financial regulators, other public authorities into three buckets. So there's financial stability and market integrity, which are usually kind of comparable policy goals So avoiding financial crises, avoiding the use of the financial system for illicit purposes, money laundering and terrorism financing, for instance. So that's on the top of this triangle. On the right side, there is efficiency, economic efficiency, and competition, usually also complementary goals. So having many providers who are able to use data for useful services. And then on the left bottom corner, you have privacy and consumer protection, which tend to go hand in hand. So the desire, the legitimate desire of individuals for personal data to be used properly and not to be used against them. And if you think of these three buckets, there are a number of areas where they can trade off against each other, where there can be tensions between different policy goals. So between stability and integrity on the one hand, efficiency and competition on the other, we have this traditional stability competition trade-off that people are aware of. There's been a lot of discussion about this in the banking sector for years. Is a more stable banking sector potentially less competitive? Is a less competitive banking sector more stable? There are different schools of thought on this, and that debate is I think still open to some extent. But now there are newer policy trade-offs that haven't been discussed in as much depth. For instance, the efficient use of data by private providers, for instance, to engage in credit scoring or to enhance financial inclusion, versus the potential for misuse of data and abuse of individuals' privacy. And finally, there's this third side to the triangle, which is the access to data for regulatory goals, for ensuring financial stability, for law enforcement, preventing terrorism or money laundering, versus the legitimate goal of individuals to remain anonymous and to protect their privacy. And that's really apparent now in the discussion on cryptocurrencies, stablecoins, central bank digital currencies. We're seeing a lot of discussion about how to promote privacy while not opening up the system to abuse. So I'll stop there, and I'm very happy to return to some of these issues in the discussion later. Here's some further reading, and those are, of course, also available for anyone interested. Thanks.
Thank you so much, John. So now we'll have Ilja. We need some tech help to get his presentation up.
So which one? Okay.
Either of the two. Either one. They are the same.
Ah, they're the same. Okay. Sorry. Okay. Looks good. Pointer is here.
Okay. So, hello. My name is Ilja Kantorovitch. I'm a postdoc here in the PFL in economics. And today I will talk about my work on AI and regulation. So for me, the way here has been very close. I came by bike, so I'm happy to be here. Okay. So if you think about AI, as John Frost has already mentioned just before, AI uses vast amounts of data, right? And this personal data can tell a lot about us, right? So on the one hand, what we want is that when we use products, that it gives us what we prefer to get. If we go on some music service, we want to see and listen to the music that we like. If we go and look to watch a movie, we want to have a recommendation that we like too. However, if we go and get a credit from a bank, we do not want to be rejected because we live in the wrong neighborhood or because we belong to the wrong minority. So in this trade-off, there are governments who try to regulate the use of data, right? To make it so that not all data can be used for any kind of purpose, that there are some limits to how data can be used to take decisions and how data can be stored for further purposes. So going to either of one extremes is not straightforward. If you say, well, let's not allow firms to collect data. well, then there might be some very practical issues. You order delivery, the firm doesn't know where to deliver it. But there's also, in this more advanced perspective, that you need a lot of data to train an AI algorithm. So many firms, many companies have like more advanced business models, more data-reliant business models that actually rely to a great extent on the use of data. However, going the other direction, saying, well, you can do with the data anything you want, use all the data, store it for as long as you want, nobody can say anything about it, gives firms free rein, but also opens the door for data breaches, data misuse, discrimination, and other things that consumers might not like. Besides just the right to privacy, that just some consumers may prefer not to have these personalized products. So, natural question is, how can policymakers decide on what kind of protections to implement, but at the same time protect innovative business models? This question is something that we have studied. No, I will first say something about what the reality looks like today, is that the data is very important for lots of business models, these innovative data-driven business models that I've spoken of just a moment ago. And I think this caricature from The Economist from 2017 captures it very nicely. So right now we talk a lot about oil, but also data has become a very important resource. And here it captures multiple things at the same time. So as oil is produced only in a few countries, so we are very reliant on these countries to import oil. But also data is accumulated mainly in a few companies that have access to lots of our data, that monitor ours, that we use very intensively. So as with oil, the question of who can use this data, who has access to this data, becomes very important. So it's also how other firms can access the data of these firms. So taking these two perspectives together on understanding the role of data regulation and data trade, I have studied with my co-authors, Simone Abis, Mehmet, Roxana, Mihet, and Huan Tang, the effects of a Californian-based privacy law. CCPA, it stands for California Consumer Privacy Act, and it basically gives the right to consumers to opt out of data sharing and to demand deletion of their data. Also, the right to understand what data about them was collected. So this is a setting where we want to understand what is the effect of such privacy regulation that is put in place in practice right now. And what we focus on is the universe of firms that offer Amazon Alexa skills. For the ones that are not very familiar with Amazon Alexa, it is a voice AI product. It is similar to the Google Assistant, Apple Siri, and there are many others, Microsoft's Cortana. You can ask questions, demand services, play a game, learn about facts, and it also replies to you per voice. Okay, so that is a state-of-the-art data-driven business model. And these skills, what's different is not just that we study what Amazon does, but these skills are special additions to this service that are engineered by other firms. So it might be I ask this assistant, book me a train ticket, and it will just tell you, well, here you are on the page of the train provider, please do it yourself. You might install a skill that allows you to actually book a ticket directly through this voice AI product. So let us have a look at what our findings are. And what we have found is that there are profoundly heterogeneous effects through this privacy regulation on different kinds of firms. And the main distinction that we have taken between two different kinds of firms, that first there are firms that have already collected some data, and there are firms who have entered this market later or have not been able to accrue large amounts of data before the introduction of CCPA. So what does it mean? How do we understand that they have already collected data? You can think about it this way. Some skills have been published and have been used before CCPA was introduced. the data of the users could be collected under different rules than after the introduction of the CCPA. So we see that some skills have lots of comments, lots of interactions. So we think that these skills, these firms have been able to collect a lot of data before data collection and data trade became more difficult. And what we find is that these kinds of firms that have already collected data, in contrast to the firms that did not experience more usage, they can collect more reviews later, they have higher ratings, people are more content with these services, but also from the financial side, they enjoy higher profits and higher stock market valuations. So there's a distinctly heterogeneous effect of such data privacy laws, depending on your ability and your possession of data beforehand. And so what we find, what's very important in our theoretical analysis is that the restrictions on data trade, specifically of giving access to small, sophisticated firms to data of large incumbents, is important to avoid anti-competitive effects. If we say, for example, okay, we protect the rights of consumers by limiting the data trade, what happens is that sophisticated firms that do not have yet a lot of internal data, however, that they need data to make their business model run, they are the hardest hit. In contrast to firms that may have a more conventional, not so data-driven business model. But what we find also in our theoretical analysis is that not all data privacy regulation need to have such anti-competitive effects. If we focus on restricting data collection, not data trade, that is, each firm has the same rights to collect insight, so that might be limited, there might be opt-out, opt-in type of restrictions. In this case, it's just a contrast between firms that have the ability to collect a lot of data in-house and firms that don't have, but there's no difference between what kind of business model I pursue. So this is something that we study in our paper and suggest that it has less anti-competitive effects. So to just sum up what I was trying to say, the message that I was trying to get across, is that these data privacy regulations, they can have important effects on firms. They can have heterogeneous effects depending on whether these firms are already established, they have already access to a lot of data, and whether their business model is very reliant on data or not. In particular, the restriction on data trade is something that might have anti-competitive effects by restricting the possibilities of young firms, of tech startups that are just starting to use data to develop their algorithms and train them and try to accumulate customers. Okay, so thank you much for your attention.
Thank you so much, Ilja. This was a very interesting discussion. It also relates a lot to the discussion we had in the legal panel, in the first panel, on whether regulation should be across sectors, within sectors, across different nations, within different nations. It's a very nice, I hope it makes the audience think a little bit about the heterogeneous implications of different regulations. So now we will hear from Sebastian Doerr, who is an economist at the BIS, and you have the floor.
So a few years ago, when fintech became the hot topic, I think there was lots of talk about financial inclusion, right? The idea was that somehow fintech would bring people into the system and unbank the unbanked. No, bank the unbanked, that makes much more sense. All right, and I think in some areas it's certainly true. Like if you think about payments, for example, new payment apps have really improved access to the payment system for millions of people. But in this talk, I'll talk more about one different category, namely fintech lending. And the reason I do so is think that there's a good case to be made that here machine learning and big data could really help the world to improve the system. And let me explain why. So the key issue in lending is asymmetric information. So if I make a loan to somebody in the audience, I don't know if you're a good or a bad type. You might take my money and run away. The product, whatever you're developing, might be good or might be bad. I don't know. So I need to screen you. I need to learn about you, whether you're good or bad. And so the traditional way this was done is you went to the bank and you said, I want to buy a house. I need a mortgage. And then you give the bank hard information. For example, your income, your education, whether you're married, where you live, and these things. But you also talk to a loan officer that collects soft information about you. So maybe, the loan officer knows you from school. Maybe, you went to church together. Maybe he doesn't know you. Who knows? But this hard and soft information together will basically determine whether you get a loan. And that can result in good outcomes, but over time we learned that there are a few issues here. So for example, I'm from Munich, so I'm a Bayern Munich fan, and one of the worst moments in my life was in 2012 when we lost against Chelsea in the Champions League final. So if I'd be a loan officer and I would have a customer who's a Chelsea fan, I might implicitly or explicitly charge a higher interest rate to that person. That obviously is just one stupid example, but I mean it holds across many dimensions, and these things have been shown to happen to minorities. At times there's age discrimination. And so basically the decision that's being made by the loan officer has discretion and can be wrong. And so in comes fintech. The hope was that by using big data, combining payments data, your messaging data and so forth, plus machine learning, you can overcome these frictions in the system. I can still learn your type, but I'm not biased, right? The algorithm doesn't have a bias. Now, to what extent this is true, I have my doubts. I mean, we learned that there's also bias in the algorithms. One hard thing here is that you can't really, it's hard to benchmark that. What is the unbiased decision? You look at the actual decision being made, there's a bias there, the algorithm might be biased, so it's hard to benchmark that. And I think a few other speakers will get back to that. So I'd rather take stock and see to what extent big data machine learning have actually helped in that field. And I have to say I'm slightly disappointed in fintech so far. So if you look at fintech lending, then there are some segments like the US mortgage market where fintechs really have gained ground. But it's probably the most standardized market you can think of. It's a very simple product. You have lots of information, highly regulated. You don't need soft information. You don't need AI to understand whether a mortgage application is good or bad. If you look at things like small business lending, fintech lending is still tiny, and that's much harder to do. There, I think the case for machine learning would be much bigger to be made. And so I'm not implying that fintech doesn't use technology. They do. It's just I don't think they do it in the way that I would have hoped. So it seems to be an efficiency-enhancing way to use technology in the back office, right? So fintechs are very quick at taking your application, processing that, and making a decision to get a loan or not. While with the bank, it might have to go to a loan officer, then escalate up the ranks, come back down, takes weeks. So in that sense, they're quicker, they're probably cheaper because there's no legacy cost. And so technology does help, but it's not what I would have hoped, right? The fundamental issue of asymmetric information is still there, hasn't really been addressed. And that's to a certain extent my big disappointment with the fintech landscape, that they haven't really made much progress here. I do think to a certain extent that makes sense. Many fintechs offer a very niche product, right? So I'm a mortgage provider, I make mortgages. If you think about a bank, they offer you a deposit account, you get your credit card with them, you get your income statement. So, banks actually know much more about you than most fintechs. So maybe the expectations we had were somewhat overblown initially. And this also relaxes me somewhat about the discrimination in algorithms we think about, because by and large, I think fintechs at the moment provide yet another option to somebody who has access to the bank anyway. They didn't really, increase inclusion in that sense. So as long as I have this option of going to the bank, I only pick the fintech if the offer is better. It might be, there might still be a bias in the algorithm, but if the offer is better, I'm still better off. Doesn't mean that isn't an issue, but I think it's less pertinent, less important than we thought initially. Now, for big techs, the story I think is quite different. So John alluded to that. Big techs means like large technology companies. They offer payment services, chat, messengers, and so forth, combine all the data. And that's where I think you can really make progress on using machine learning to understand what type you are. So in China, for example, there was a very inefficient system of state-owned banks. In came the big techs, offered, it's like kind of like a lender on steroids. It was really like Amazon marrying Wells Fargo, marrying Facebook. And then all of that together allowed them to produce credit scores which are really very tailored to your type, whether you're good or bad. That has really helped bring millions of people into the Chinese financial system. So that comes at a cost. So John showed you the triangle. You know, there's issues about privacy and so forth. I don't have the time to go into these now. I'm sure we'll discuss them later, but I'll just stop here and conclude that, you know, it's not technology doesn't help the system, but I would have hoped for more, let's put it this way, from fintechs. And I'll stop here. Oh, and I didn't use my slides, but there was nothing important on there anyway.
So we look really forward to hearing more from you in the panel discussion about how to regulate these fintech institutions and what the implications will be. So now we'll hear from Mehmet Toral.
So
It's before lost.
it's here.
No, one lower, that's the PDF. Great.
Pointer is here.
That's very helpful, thank you. Sorry, can't help it. I'm the token lawyer here to talk about the legal stuff on the regulation panel at this point. As any lawyer, I put great stock in words, their importance, and what we do with them. Part of my input and the justification for why I'm here is that by trade, I'm a lawyer for startup companies, and so I have to spend most of my life explaining to extremely smart people why their brand new fantastic idea is about to get buried or made significantly more expensive than what they expect because of some regulation that they've never heard of and did not expect to come in any way and affect them. So it's a very practical issue on a day-to-day basis. Now, I'm not going to talk to you specifically about legislation, but what I would like to do is invite you to a little bit of creative thinking here. And what is going to be interesting, perhaps, is that you might recognize some of the points already raised by John, Ilja, Sebastian in their talks about this, but from a slightly different perspective. So if we work our way through this, of course, lawyers are all about definitions, the importance of definitions. You might or not be familiar with Humpty Dumpty. Humpty Dumpty sits on a wall. He's a character in a story by Lewis Carroll. And his great particularity is that he gets into an argument with Alice, the fabled one from Wonderland, as to the meaning of words. And Humpty Dumpty says, when I use a word, it means just what I choose it to mean, neither more nor less. The question is, says Alice, whether you can make words mean so many different things. And the question is, says Humpty Dumpty, which is to be master? That is all. So who decides what the words mean and what are we actually talking about? The definitions are extremely important because behind the terms artificial intelligence, there are a great variety of different realities that are hidden. And the fact is that we are all extremely focused on one of those realities because of the way it has come to be crystallized through the AI Act in the EU that forms a certain way of thinking about what AI is, which is a huge trap, even if it's an interesting one. And it also goes back to other ideas of what certain regulatory terms mean. When we start talking about artificial intelligence in the EU context, we start talking about data. Everybody so far has been talking about data, 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 data. In fact, you'd be forgiven for thinking after listening to this type of speech that there is no artificial intelligence other than data. And then there's the importance of actors. I mean, who are we talking about, really? Important, obviously, because different actors have got different priorities, and not only priorities, but they might be apprehending the game that is being played in a subtly different manner. And so they might seem to be having the same discourse and talking about the same thing. Heck, you might even think that they're on the same board. They're just not playing the same game. And so it's important to identify who the actors are here, what their priorities are, and what they are after. So with that colorful introduction, I'm going to inflict on you some very bright yellow. I'm not going to read all of this, but this is the definition that is taken for AI, or the description, rather, of what is supposed to be AI within the scope of the EU AI Act. It's one of the recitals, this long wall of text at the start of the Act, which explains to you why this Act is being adopted at all and what's really going on. And what's interesting here is that not to belabor the point too much, but the EU tells us that the notion of an AI system should be clearly defined. I mean, that's nice. I mean, that's what we're expecting, of course. It's supposed to be a piece of legislation. We'd like to know what we're talking about. And the objective is legal certainty. It's laudable. We all like that, except that we need to accommodate future technological developments. So there's already an admission somewhere in the middle of this system that this is going to be a moving target. AI today is not AI tomorrow, and so there is already an inherent difficulty in regulating what we term as AI here, because we have to acknowledge when we start that this is a moving target. And there's a very interesting reason for this as well, which I'll get to in a second. It continues by saying, European Union, continues by saying that the definition should be based on key functional characteristics of the software. So basically it's defined by how the software is built. There's a whole appendix for that. Not very interesting for lawyers like me, but someone who understands that stuff probably finds some interest in it. And then more interestingly, from an intellectual perspective, AI is defined as something that generates outputs which influences the environment with which the system interacts. The idea being that if somehow there is no influence on the environment that we can perceive, well then artificial intelligence is irrelevant from a regulatory perspective, which, seen as a lawyer, is not entirely untrue, but intellectually it's already a trap of sorts here. Now, if we go to a more human approach of this, and I find all of my knowledge on Wikipedia, I recommend it for everyone. Artificial intelligence is intelligence demonstrated by machines. Hurrah, this is really great progress here in terms of definition. And what it tells us for intelligence, however, is also interesting, is a sort of general, food for thought. Describes it as the ability to perceive or infer information. So information comes in. This is where we're talking about big data, data somewhere in all of this. Information comes in, we retain it as knowledge, and then it goes out. There's some form of an adaptive behavior. And this is where we recover our definition of what is being provided by the EU. There is an output that affects the environment in one way or another. Now, what's the relevance of all of this? You might be familiar with something called the AI effect. The AI effect is the general human trend and the trend on the AI in the AI industry to have, at any point in time where some form of artificial intelligence is developed, someone coming up and saying, but that's not really intelligence. There are studies on this topic. What is the AI effect? Why do people have this AI effect? Why is there a tendency of people to automatically come up and say, well, what you have just provided to us is just an example of a decision-making process, but this is not artificial intelligence. There is a real thing here. And it's funny because if we go back to the EU in the explanatory memorandum that goes with the proposed AI Act, we actually see that deep within this apparently neutral definition of artificial intelligence, behind it, there is actually an AI effect at play. And the AI effect is subtle but perverse. What is being regulated here is the AI with its specific characteristics, and the specific characteristics of AI, according to the explanatory memorandum, are opacity, complexity, dependency on data, autonomous behavior. Now, basically what we're saying is that it's AI if we don't see what it's doing, if we wouldn't understand it even if we could see it, if we couldn't stop it if we tried. So this is all a way of saying this is stuff we don't understand, right? We are calling this AI and we are attributing these characteristics to AI and saying this is what AI is, but in fact what we're saying is AI is the stuff that we do not understand. We don't understand what's going on. There's a black box here, stuff comes in, things go out, but we don't understand what's happening. And this is the core of what's going on here. The dependency on data is whatever it does would still be problematic, and this is the core of the regulation. It's sort of an offshoot of a data protection concern at some point. Data is being used, and even, whatever we do with this, we're going to have massive problems. We've got this huge GDPR thing going on here, and massive reams of data are being moved from point A to point B through black boxes. This is a huge problem. So the definition of AI within the regulatory framework is problematic. So what's the point of all of this? So quite obviously, if we have a system where I can put an input, get an output, and I know how it works, this is not AI, right? We agree that this machine is not AI for EU purposes. But then what do we do with a high-frequency trading system? So this has so far not been apprehended in any meaningful way as AI, right? It's a system which executes a set of instructions which may or may not be understood by the average human being. I'm quite sure they're not understood by the average human being. It's developed by very high-class mathematicians who have some idea of what they're doing, but other than them, No one. So it definitely fulfills a complexity factor. It's perhaps not opaque. We can get an idea of what the algorithm looks like, but it is sufficiently complex. But still, there's a deep problem in saying, this is AI. Should we really be regulating this in the way that we are regulating AI? So in the financial services industry, understandably, at least at the level of day-to-day, my clients, people providing solutions for an industry, there is a lack of understanding as to why this type of regulation should have any impact on what they do at all. They will be the first ones to tell you, well, this is not AI, we're just executing a set of instructions, right? And to take the Washington Times article on the deep blue beating Kasparov, I mean, in fact, that's just not thinking, it's just being stupid very, 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 very fast. It's a machine just executing decisions. Is this even AI? So the EU is likely at this point with the AI Act to arrive at a conclusion that it may actually be AI because it does include a risk factor. There's a risk that needs to be dealt with. And so we're in a topsy-turvy situation where we are defining what artificial intelligence is for the purposes of regulation through the prism of the risk that it poses to the actual users at the end of the day. Well, not the users or the people affected. And this brings me to the actors, quite neatly. Nice seeing. So we've got three categories of actors, and these actually correspond to an extent to the points in the pyramids that were put on screen earlier by John. There's the set of actors: government, public authorities, financial service providers, people making a buck off this, obviously, and then there are individuals as an object of protection in all of this, because individuals, I mean, let's face it, are not meaningful users of AI, voluntarily at least, in the sense that they should be regulated in their use of AI. They are the targets of AI. They benefit from an AI-powered service, and then there is an externality on them that needs to be managed. What do we know about state actors? Well, there is fear which stops adoption of AI-favorable rules and adoption of AI generally, potential human rights breaches through action or inaction. There's a difficulty to attribute blame in an AI system. If information comes in, I don't know how it's being processed, and an output comes out. Who do I actually blame the output on? What happens here? So there's a legislative issue. There's a potential financial instability issue. Back to the high-frequency trading matter. If we don't understand how it works, if it goes too fast to control, will this actually cause systemic problems? So there are a whole load of fear factors. And then there are a couple of greed factors which might point towards an adoption or a favorability towards AI. There's a potential to optimize security services. Also applies to financial regulators. The FCA in the UK has been exploring the use of AI-powered tools to see whether compliance is being carried out properly. There's a potential to increase wealth, optimize economical outcomes. At least President Macron would very much like it to be so, and he would like millions to be injected into a specific sector of the economy for AI. There is no real thought on a macro level as to how we would use AI to replace our fabled invisible hand to actually move our values around in the economic chain. There's no state-level thought about this, but it's still a target for somehow, optimizing wealth. But basically, for the state actors, there's a limited drive to adopt an AI-favorable approach at a collective level, and this was touched upon a bit earlier. It's not the role of a governmental authority to promote this. The role is usually to try to maintain some form of status quo ante, or make sure that while things are moving very fast, as few things as possible get broken along the way. Now, if we move to the individuals, well, of course, there's a fear of potential human rights breaches through state action for individuals, potential discrimination issues through private actor action. Am I obtaining the loan I should be obtaining? Have I entered into the machine that somehow I'm a Chelsea fan and the person who coded the software behind this was a Bayern Munich fan and he put this into a black box and I have no idea about this? Who knows, all sorts of weird people around. There's the greed factor, which is quite limited, potential gains in comfort, access to services, but no one's going to be fighting outside in the streets and raising a flag and a banner in favor of artificial intelligence because this allows us access to a whole new suite of services, right? It's a nice to have, but it's not something that the individuals are going to be fighting for. Potentially cheaper services as well, notwithstanding, adverts. The real drive here actually might be simply that Homo sapiens wants new toys, right? I mean, as human beings, we have a drive towards improvement, and so we want new technology. I think we do, at least, I do. I haven't replaced my mobile phone in a while, but that's because they've stopped progressing, but still, the drive is there. Other than that, though, there is a very limited drive to get something done, but there's a limited drive to resist anything on an individual level as well. People are getting tired of data protection. Quite frankly, the cookie banner is, I've had enough of the cookie banner at this point. Now, if we move to the financial service providers, and I'm going to end with this, obviously there's a fear of losing market share for incumbents. It's interesting to see that additional regulation, in fact, raises a barrier to entry on a market. And so it's quite likely that large-scale actors on any market will promote new legislation and new regulation because, you know, they can deal with it. JP Morgan has got the type of budget that a spin-off from EPFL can only dream about in their wildest fevered dreams. On the other hand, there is, of course, the usual greed factor. These are financial service providers. For the incumbents, there's the promise of lower costs, higher margins. For the new players, there's a promise of new markets and lower barriers to entry in cost of implementing a certain type of service. You know, artificial intelligence brings all of these promises that we can do so much more with so little. In fact, I have this machine that has replaced potentially 100 back office employees. It's absolutely fantastic. You know, it's a lower barrier to entry. And so there is a potential to raise barriers to entry if we put too much into regulation. There is a tension there. But the truth of this is that the actors on the financial market, the main actors at least, are balanced out, the way I see it from my practitioner's perspective, to a point where there is not really a drive towards adopting truly AI-friendly initiatives. There is simply a drive towards making sure that what AI regulation may be adopted by the states does not completely break existing business models, create too much space for new ones, or completely stifle new growth entirely. So it's a bit of a compromise situation, and that might serve to explain between all of these actors why we're reaching the type of regulation we are these days. Et sur ce, voilà.
Thank you so much. That was really interesting, and I look forward to talking in the panel. If we can still hear in the panel, we will talk about whether there's any hope for fair regulation. All right, so we will now hear from our last speaker, who will be joining us from Zoom.
Yeah, so hi, everyone. It's a real pleasure to be part of this panel. Unfortunately, I cannot be with you in person. Kind of have a similar problem as John. I experienced symptoms on the weekend, and so I didn't want to share that with you. So I'm thankful to the organizers that I can chime in here in a virtual format. And as the last speaker, I want to give you some insights from my own research and what I think are currently quite hot topics in economics research and related disciplines. So I will talk briefly about data-driven market power, which I think ties nicely to the talks we already have heard. I then also want to point out some new findings and some insights on algorithmic collusion and how this may pose a problem. And then I think a third topic that is currently very important also for the legislation that we see is the whole topic of explainable AI, transparency of AI systems, and the consumer behavior. And there's a lot of ongoing research in this regard. But I will focus on the first two parts, but we may come back to the third part in the discussion. So data-driven market power is a concern that I think is currently shared among many policymakers. If we think of the Digital Markets Act, it's quite pronounced there, but also if we look at recent antitrust proceedings. And the reason for this has been emphasized before, and I think it's because data is a very special resource, and it's an important resource for AI applications. From an economic point of view, it's one aspect why it's so interesting is because data is a non-rival resource. That means several entities can use a data resource concurrently without that resource ever being used up. And this gives rise to a conundrum. So on the one hand, this means that we could gain large social gains out of using that data and sharing it very broadly. But if we look at the individual actors, then what we see apparently is a lot of inefficient private hoarding of this data. This also stems from this non-rivalry resource because we also have research on that shows that precisely if you share that data, if it's out there for many stakeholders, we would expect very intense competition, and this would then drive down the business value of data. So from a policy perspective, we're faced with a trade-off with respect to data access. So on the one hand, we could gain static welfare gains in terms of more competition, allocative efficiency by sharing this data, by giving as many firms as possible access to data. But this, on the other hand, then could diminish the dynamic incentives of actors, meaning the incentives to innovate could be lower, to collect data in the first place would diminish if it's clear that after I have gathered this data, I would need to share that possibly also with my competitors. And against this backdrop, there are several policy challenges, and I think the most prominent one at the moment is the problem of data concentration and data-driven market power. So there are additional factors that may lead to the observation or the dynamic that a data-driven competitive advantage is not immediately imitable by other competitors. Still, even if we think we have something like data-driven market power, this does not necessarily, from an economic point of view, would justify regulation. What we usually require from that perspective is that there's some theory of harm. So we have a lot of sectors where we have market power, and we're okay with that, and rely on competition law to deal with this market power. So in one article, we set out how such a data-driven theory of harm could be established, and it very much centers around this notion of data-driven network effects, which has been discussed in the economic literature quite popularly by now. There's also first empirical articles on that. And what it basically means is that if you're a data-rich firm and you use especially AI, you're probably capable of providing higher quality services. These higher quality services usually then attract more consumers, and because usage is then associated with more data creation, this data as a byproduct then can be used again, and this could give rise to such a positive feedback loop where the data-rich firm gets even more data and gets even more bigger. So this could threaten the contestability of digital markets that rely on such data-rich applications. And more problematic, even, it could give rise to this domino effect, which means that if you can innovate as a firm at lower costs because you have access to special data resources, then you may be in an advantaged position to also leverage your market power that you have established to other markets, leading to further monopolization towards these integrated ecosystems that we see. Furthermore, there could be then a threat of lower overall innovation when we have more and more tipped markets, so the competitive pressure may be diminishing, which incentivizes innovation. And there's an emerging literature on so-called kill zones, meaning that startups that try to compete with data-rich dominant firms head-on-head, that they actually have access to lower funding and venture capital. On the other hand, we, from a policy perspective, need also to consider that, of course, there are important efficiencies from the integration, from these network effects, and also from economies of scope and scale that we have in data. So one question that you then can ask is, what should actually be the policy goal that we would follow? And in our opinion here, the main goal should be on niche entry and growth. So we should really protect new and emerging markets from becoming subject to this domino effect and keep them open for new players so that over the long run, we still have a very diverse competitive field across markets. You can then take the next step and ask, okay, how can we achieve these policy goals that we prioritize? With regard to data access, there's a possible classification here. So you could either focus on empowering users through higher transparency, through data portability, or you could look more into facilitating open access and data openness, So meaning you give access obligations to data, you mandate bulk data sharing. And the third approach would be a little bit in contrast to that. So you could also focus on actually limiting the data scale of these data-rich firms that are out there, for example, through data siloing and structural separation as a last resort. If we look at the Digital Markets Act, we actually see elements of all three approaches here, and we may go into detail later in the discussion of that. What I also want to highlight is that when we talk about regulation, we are often economists and lawyers here, but for this type of regulation, the technological design will have a really important impact on what will work in the end and how the effects of regulation will vary. So briefly then on the second part of algorithmic collusion, which then goes to a broader topic on the regulation of autonomous AI decision-making. So regarding algorithmic collusion, we have quite a buzz in the economic literature of recent findings that find that artificial intelligence in the form of reinforcement learning, that if you have them in simulations, that they can actually learn price levels that are above the competitive equilibrium prediction. And this has raised concern in the legal literature, but also among competition authorities, that these autonomous algorithms could pose a threat to consumers in the form of very high prices. So there's several concerns about that, but the most important, I think, is that algorithms could really implicitly coordinate on higher prices without that ever being programmed into them. So as a result of this learning process, we have this collusion, and this, of course, poses several policy problems. The remarkable thing about these studies is that if you take these trained algorithms and if they have reached a collusive price level, and then you pose them with a competitor that tries to deviate from this profitable price level, you see that these algorithms actually learn a punishment strategy where they then try to punish the deviator by also setting lower prices. And we then see that these algorithms turn back to this tacitly collusive outcome. And this is in line with the economic theory how tacit collusion can be sustained, although individual actors have an incentive to deviate from that because they could make more profits in the short term. But because this punishment strategy behavior is learned, there's really also a rationale behind that, that this is not only done by accident, but that this is profitable over the long. What should be kept in mind, so there was also quite a hysteria about that, is that we also know that humans also tacitly collude. So just here to illustrate from our own experiments, where we have this benchmark between perfect competition and perfect collusion, and we had in a market structure with two firms, let them play by student subjects, we also see that they actually achieve a very high degree of tacit collusion. And the comparison between the outcomes of AI and humans, this is, I would say, very much research in progress and should also tame a little bit the concerns that we may have about this tacit collusion among algorithms. I want to conclude then here with respect to the question, okay, what can we do about it? And I think this is now applicable to a broader class of autonomous AI decision-making. It's really a fundamental policy question whether we want to opt for an ex-ante safety approach or whether we want to rely on ex-post liability. And of course, we can also combine. The main trade-offs here are that on the one hand, user protection comes likely at the cost of innovation. The stricter I am, the more forward-looking I pose some limitations on the AI systems that could be out there, the more the room for innovation is limited. And on the other hand, of course, ex-ante safety regulation provides you with some legal certainty, but then on the other hand, flexibility is very problematic. And as we have seen in the presentation before, of course, the policymakers try to deal with this trade-off by introducing this language in the legislation, which somehow then could things make even worse. Liability, of course, is not as straightforward as in other domains because we have this autonomous, less predictable decision-making. And then, of course, harmful conduct is very difficult to establish on a causal basis. Even to detect whether some harmful conduct was emerging from an AI system is not easy to detect. And then if we think of this algorithmic collusion issue, there it's not even clear who is really responsible for an adverse effect that we see on the macro level, because it emerges from the interaction of several decentralized players. So you could see this proposed EU framework that we just heard about, where we have this risk-based approach, that they try to balance this ex-ante safety versus ex-post liability approach by having this different risk classifications. But there are a lot of open questions out there, I think, and also things to critique, as we just heard, especially starting with the point, what is actually AI and what should be regulated under such a regime? So with that, thank you, and I'm looking forward to the discussion.
So thank you so much, Daniel. That was really interesting, the way you presented both the positive and the normative implications of regulation, and your research on algorithmic collusion. That was really interesting. So let me kick off with a question for you, actually. So what do you see as the key competition policy issue in the context of AI, and how do you see these concerns addressed in current policy proposals such as the AI Act or other broad European laws such as the DMA or the DSA proposal? And it's also a question for the other speakers as well, if you'd like to chime in afterwards.
Okay, I tried to go ahead. So I think what is also interesting to me that we saw now for, I think, all of the 5 presentations is that data seems to be a very important thing to consider. And as I tried to line out very briefly here, I think the issue of data concentration poses a certain risk to contestability of markets and then to effective competition. If we look into that issue specifically, I think there's not so much in the AI Act about that, but a lot in the Digital Markets Act. So if we look at the European Union, there the concern, I think, is especially targeted at the big gatekeepers and the potential problems that are there. I think the view is, of course, even broader. It's not only about data, but if we look into it, in the potential remedies that are proposed and the obligations for these firms that are then deemed to have gatekeeper status for some core platform services. I mentioned these different regulatory approaches. We, for example, see remedies where the European Commission proposed to have data portability, not only for end users, as we have it in the GDPR, but also for the business users. And then what I think is important, that it is on a continuous and possibly real-time basis. So I think if we look at the current right to data portability as we have it, we only have very limited pro-competitive effects. And I would argue that some of that is because the data you can get out there is very limited. And what you rather would need is some continuous access to fresh data, and maybe also data that is not only personal in the very limited legal sense, but to a broader set of data. What you also see in the DMA is something like data siloing. So these gatekeepers are prohibited to combine data among their core platform services, and I think also their other related services, without the explicit consent of the user. Here, I think one could be a little bit skeptical how much this consent requirement will actually stop this data concentration. Because I would argue if the big popular platform firms want you to give consent to that, they always found a way to get this consent. And it's very difficult to say to Google, don't use my data for this or that, for example. And maybe just the third point and approach that is in there is the bulk data sharing for search engines. So there it's explicitly that a dominant search online engine, and this probably would especially be Google, that they would have to give access to query data, for example, to providers of other online search engines. There, I'm a little bit questioning why should this access only be for other search engines? So if we really have this idea that we want to use this data broadly and use it for other markets that are actually emerging and also new AI applications, why does it make sense so much to focus only on other search engines?
Building upon Daniel's answer, I'm going to ask Mehmet now a question from his perspective as a practitioner. Where do you see the biggest pitfalls with the current policy proposals, and do you think that the legal uncertainty about the concepts such as the AI risks categories that you mentioned in your presentation is going to make some firms shy away from developing innovative business models?
I don't think anyone is going to be shying away. I do think that the main risk that there is that a lot of the regulation, at a low level at least, is simply going to be ignored. The plain, simple fact is that for small-scale actors, if compliance with a piece of regulation or legislation simply becomes too onerous with respect to their business model, the arbitration is not between carrying out the activity and not carrying it out, it's between the cost of going forwards and simply stopping. And if they realize that the cost of moving forwards is potentially low simply because there's a low risk of realization of what's going to be happening, and then the issue is one of enforcement. If there's a low probability of enforcement and the cost is not prohibitive, then ultimately small actors tend to ignore this type of thing. And that's my experience, at least. I'm not going to be naming names, but GDPR has not necessarily led to a widespread adoption of sound data protection principles, to make a euphemism of it. A lot of firms have simply adopted a privacy policy, put it up on their website and said, okay, that's it, we've done our job now, we can just move on. A lot of that has even been simply a copycat approach of what larger firms have done. So small fintech actors will have gone on the websites of large incumbent banks, picked up JP Morgan's website, seen what a local private bank is doing, checked what UBS is doing, and then simply copy-pasted whatever terms they've seen and not really wondered whether it's applicable to their business model or tried to check whether it has any relevance. And this goes throughout the whole chain of actors. It's not the type of action which is limited to very small-scale actors. I mean, I know for a fact, for instance, that a lot of what people would consider medium-sized banks or large private banks will simply automatically align on the Swiss market on whatever UBS and Credit Suisse are doing, because it will be seen as an acceptable risk to take. If the big boys are doing it, then we can do it this way as well. So having regulation does not necessarily lead to the type of results one might expect. Part of the issue is that the regulation is always difficult to understand. I mean, I'm a lawyer, right? I spend my time talking about this kind of thing to clients. I can't for the life of you explain to you coherently what's in the GDPR today. I mean, I can give you a long speech about it and give you the impression that I have a very good idea of what's going on in there, but it's an extremely complex piece of legislation at the end of the day, and there are a lot of uncertainties. The same thing is going to happen with any form of AI regulation, and it's going to be built on in terms of practice, years and years of other practices coming and layering themselves on. But there's not going to be a paradigm shift from one day to the next and all of a sudden an entire market dying out because a piece of legislation has come into force.
Wants to build on this? All right, so related to this, I'm going to ask John, but also all of you, if you'd like to chime in. So John, what do you think, how is the disparate regulation of data across different jurisdictions affecting the financial landscape?
Yeah, thanks a lot. So we've heard about GDPR and CCPA, and I think these are very much prominent examples of data privacy legislation. But there's also new data privacy legislation in China. Brazil has its own data privacy law, which is to some extent an equivalent of GDPR. There are proposals being discussed at the federal level in the US and also in India. And I think that, as we've just heard, and I think as the research is showing, the data privacy rules that are in place do not seem to yet be achieving what legislators maybe were hoping for. And they are nonetheless quite different from one another. So I think that at the global level, there is this risk that disparate, differing data protection rules may lead to some fragmentation, may lead to higher costs for firms that want to operate across borders, and particularly I'm less worried about the big techs. They have plenty of lawyers and specialists to handle that. But of course, smaller firms that may want to enter in other markets. And I think that we've been discussing this. There isn't really a global body that is in charge of data privacy issues. For banking regulation, we have the Basel Committee, hosted, of course, at the BIS. For securities markets regulation, we have IOSCO, whose secretary is in Madrid. There are bodies that are responsible for many different areas of financial regulation, competition, even money laundering and financing, combating the financing of terrorism. There is a global privacy assembly that was chaired in the past by the UK Information Commission, right now the head of the Mexican Privacy Authority. And it brings together the privacy regulators around the world and allows them to share insights with one another. But there aren't really any global standards of the like that we have for banking regulation or for other areas. And I think this is going to be a really important issue. As countries grapple domestically with how they should, regulate data privacy, how they should define rules for the control of personal data, they also have to consider what's being done in other jurisdictions and whether these things are coherent. And I think that there's already a lot of political issues around this. There's a lot of concern about the policies of some, especially emerging markets, on data localization. Basically just putting up a wall around which data can be used outside the country. India, for instance, China have instituted data localization rules. US authorities in particular are very concerned about that. But yeah, I think that right now there's not really a forum where these things can be discussed multilaterally. And I think that's going to be a huge gap, and it'll have a big impact on the ability of fintech, big tech, financial services to operate across borders and to use data in an efficient and responsible way.
So it seems that we've been talking a lot about data, but as Mehmet mentioned, AI is more than just data. It's also algorithms, and it's very difficult to do research on this and to regulate AI because we don't observe the sort of data that firms have. We don't know the sort of algorithms that firms have or banks have. So let me start by asking one question on data, because Sebastian actually has some work on data privacy protections. So you have looked at whom consumers trust with their data. So can you tell us a little bit more about this?
Sure. So actually, together with John, we looked at who consumers trust or whom they trust. If you ask John, oh yeah, great, John, thanks. So that's part of the paper. And so, by and large, surprisingly, people trust banks a lot more than, say, fintechs or big techs to handle their data. That is true in the US, which is the left-hand panel data, but also in other countries. So this is just, a pattern which is quite persistent across different groups of the population. But there are differences that, for example, minorities in the US trust banks less than white people do. And so I think what to me here the challenge is, if you want to price data and say consumers should be paid, for giving up their data. So how do you price that? Is it like the market value to the company? Is that what it's worth to me? And then if so, I mean, okay, so it might be worth to you X euros and to me Y euros. I find it very hard, and so in a perverse case, I could, get my WhatsApp phone to just send messages all day long to create a cash inflow for me because I don't care about my privacy, but I'm getting paid for the data I create, in a perverse way. And so I find there's a somewhat inefficient way to discipline companies. Then probably just a tax is the easier way, and you lower my income tax. So I don't think there's an easy solution here, but I sometimes feel like empowering the user also means overburdening the user. And, I don't want to have all that power over my data. I don't know what to do with it. I don't know what my data is worth. I don't know, privacy is a right, and I don't want people to use my data. But if we all think like that, we can't have innovation, so it's tricky. But maybe, I'd rather outsource my empowerment to some entity I trust that oversees that in a different way. I don't know if there's other opinions here. Maybe John has something to say as well, but I'll stop here.
It's a difficult one, right? I've stopped caring about my data. No, really, it became a choice at some point. I made a conscious choice to stop caring about it. Whether it's responsible or not, who knows? I'm sort of banking on the fact that it's going to be hidden somewhere in the reams of data about you. But I have, as a citizen, despite everything that is being done to provide me with the keys to refuse a use of my data in all sorts of ways, refuse this cookie, accept that one, and all of that, at the end of the day, it just became too much noise, and I started to accept everything, and I stopped caring. If the button is easily accessible to refuse, I click it. If it's not, I don't. So that's already one thing. And the other question is, if you can't price data, then perhaps the question is the wrong one, because you're trying to answer a question which clearly does not have an answer. Maybe it just becomes a common good at that point, in which case having a free or at least broad access to data becomes more relevant as an approach than really trying to price it for the citizen. That might be actually one of the real philosophical drivers behind all of this. And to circle back on what John was saying earlier about the fact that there are no international fora organizations which deal with protecting data, as opposed to, for instance, what's happening in the banking industry, Basel, etc. It's interesting because the comparison is perhaps not the most apposite, right? If we consider data as a resource, then the comparison should perhaps be with gold, oil, air, water, something like that, rather than with the financial services industry, which is regulating its own actions. And so if we look at what there is in terms of natural resources on the international level, on a global scale, well, except in areas where the people who control the natural resources are able to organize themselves, so for instance, OPEC or something similar, there is no real international organization which will truly have a say in how people mine for gold in African countries. It just doesn't work that way. And so in data, we're pretty much in the same situation. There's a resource, it's up for grabs, and chances are if there's an organization that comes out to regulate it, it's going to look like OPEC and we're not going to like it.
Daniel?
Yeah, maybe I can also add a little bit to that, because I think what we just heard by Mehmet is a pretty good sign of privacy fatigue, which we know from the empirical literature, which is a real thing. and which is also why I'm a little bit skeptical of providing the user with too much of a burden. Although it's interesting that in the new Data Act, for example, the European Commission seems to double down on this empowering consumer style, because there the consumer should get the data of all the connected devices that are then produced, and not only the big ones, but by every firm. So I'm a little bit curious how this will work. I think to make it work, we first need not only transparency, but also control. Because I think a big problem of this whole cookie banner thing is that, okay, we get the information, but then we don't really have the actual control to have it the ways we as a consumer may prefer to have it, either because it's simply not possible, or because there are each time I visit the website, I get the banner again, and at some point I just say, okay, then take my data and I'm fine. So I think this focus on transparency should be also more complemented by a focus on control, and not only with respect to data, but also when we then talk about algorithms and what you can actually do with this transparency. And the second part I would emphasize is that indeed we need to support the user somehow, either by third-party organizations that act on behalf of the user, or this is why I also emphasize the technical design. So can we have technical support for the user, that I can somehow state my preferences, what I want, but then this whole configuration side, this whole consent side is not done on each visit, but is, for example, automated by my preferences that I somehow stated in my browser or in a different gadget. So I think here again, the technological side and how we implement this is very important.
So I wanted to jump in as well and compliment something that Sebastian had said. So Sebastian was talking about, the difference in willingness to share data by counterparty, so between banks, big techs, fintechs, for instance, and also, by race in the US. We saw indeed that there were differences between minorities versus white respondents. And one of the really interesting ones that comes out pretty consistently is gender. So men are persistently more willing to share their data in exchange for betters on financial services, at least, than women are. So maybe Mehmet is representative in that sense. Maybe men in general are just a little bit lax about our data privacy. And we've been trying to dig into why this is the case. What is it that explains the differences in preferences? Is it that women are more worried about personal safety, discrimination? Is it general risk aversion? And we're still very much looking into this. I mean, one thing that's really striking in separate research that we've been doing for a survey of US consumers is that it seems that this gender gap has increased in income and education. So it's not that, as people become more educated, these gaps diminish. It seems to be the opposite. So this is important, and I think that particularly, given this diversity of preferences within societies, and given the externalities around data use, I think that it's very difficult to legislate and to define rules that apply to everyone and that make everyone comfortable within a society. And on the externalities, just to make this point very clear, if I or Mehmet decide, we don't really care about data privacy so much, so we're happy to, share basically everything with a potential lender, and and the next person comes along, Roxana is more prudent than we are, and doesn't want them to, look into her, social media feed and everything in pricing her loan. She may be at a disadvantage, even though she's, legitimately protecting her privacy. So our decision to overshare actually imposes an externality on her. And I think that, this is a reason why we really should define in society which are the types of data that we want to be used for things like credit or insurance or other financial services, and which are the types of data that we think are off limits. We already think that genome data should be off limits for health insurance. We don't want our health insurance company charging over health insurance because they know that we'll have a higher risk of cancer later in life. And maybe we don't want our bank or non-bank lender charging us more because we have friends who've been in prison, just to name an example. So I think that this makes very clear that we do need to define rules on these things. We do need to define what's off limits. And once we've done so, we should probably talk with people in other countries and aim at some sort of international harmonization on these things.
Okay, since everyone has said something, I should say something as well. I agree with the other participants on the podium that to some extent letting consumers decide on every web page on 10 different things and what to share, what not to share, is not something that everyone can do in a meaningful way. And in this sense, blanket solutions can have some impact. I think there's been a shift and some tools, for example, from Apple, providing like a possibility not to be tracked in all kinds of apps, which I think many people are using. There's been a shift in web browsers to have more like restrictive default settings in terms of tracking to protect your data. In some other areas has been happening as well in terms of end-to-end encryption in messaging services, for example, which were previously not encrypted. Now the default most services is that they are encrypted. So this kind of data is off limits now, which makes it easier for consumers to protect maybe their most sensitive data. So it might be that, as someone said right here, that stating your preferences and have this being considered by websites that you visit might be a viable option.
So let me ask you a question, because you have some research on this. So clearly there's lots of heterogeneity in the way consumers want to share their data. Mehmet is willing to share everything. I don't have any social media personal account. But at the same time, I really enjoy the fact that Netflix is tracking what movies I watch. So I'm very happy to share my data with this service. Do you think that data privacy laws are putting an end to personalized products for certain categories of consumers, for all?
Thank you very much for this question. So in some sense, you can distinguish between what's happening on the consumer side, what's happening on the firm side. If I'm a consumer, I'm happy to share my data. I'm happy to use Netflix in the first place, knowing full well that they are tracking my watching behavior and giving based on that recommendations. I think there are many people who find this attractive, still using it. I think what we see today is indicative what we can expect in the future. But of course, if you say that your business model really relies on collecting data that is not strictly generated inside your application, your service, for example, Netflix, you visit their website, they know full well because you have an account and you watch their stuff. If you have a business model that relies somehow on knowing who you are before they even met you, then it might become, of course, more difficult for these firms to provide a service like that. But for me, it's not very apparent right now what kind of business this might be. So to just sum up, I think if you're a consumer, you're interested in using services like that are in some sort personalized. If you don't have a problem with that, you can share your data. If, of course, you're the only person who shares the data, then it's impossible to make predictions for you, because it's necessary that there are many people sharing the data to see a pattern, what you might like, inferred from the behavior of others.
Let's go back to AI and finance, and let me ask you a question on your disappointment regarding fintech. So, I mean, there's lots of hope that fintech can democratize finance, but there's a big chunk of literature that has shown that it can also exacerbate inequality, lead to algorithmic discrimination, or even encourage criminal behavior. So in the US, for example, there were examples of fintech companies that were giving loans to different firms for COVID purposes, so for them to survive COVID. And you had a bunch of like mom and pop shops. So I know there was an example in the media where one woman created a company to hire someone to shoot her husband using a PPP loan from a fintech company. So, so how do you think fintech companies should be regulated? Should they be regulated as regular banks or not?
Okay, so I don't know how exactly she got her husband shot, but I don't know if the bank could prevent that. I mean, as long as the application is, fair and square, you get the money for a purpose. Short story, I do believe in same activity, same regulation. So if you do what banks are doing, maturity transformation, credit risk, and so forth, you might as well be an actual bank. But when it comes to the more narrow question of how you price your products, how you screen your borrowers, banking regulation, the first thing I think about is like capital requirements, is deposit insurance. So these are aspects which are probably not the most relevant to prevent discriminatory pricing in your algorithm. I think there are other tools which might be more targeted. So I don't think there's a need to make everybody a bank, because being a bank is, a bureaucratic nightmare. It's a good business model, right? You get an insurance for your deposits, you can make loans, you get a franchise value, all these things. But I mean, most fintechs offer very narrow products, so I don't think they need to become a bank necessarily. I think the fundamental issue is that you have a conflict between a good algorithm that is complex and opaque and, gives good predictions, and something we can explain and understand. And I mean, if the EU is serious and says, we don't get it, we can't allow it, that is bad news for good credit scoring, I guess, because to a certain extent that means we need some opacity in there, because there are attempts to make it better, but it's still very hard to do. So I guess we just have to live with a certain friction. I guess we can still benchmark things in outcomes to what we know, in a more or less frictionless setting has been the result before. But I mean, it's a political choice to make how much we want to take into account or accept that there's some friction and therefore better screening versus understanding exactly what determines that. And I don't have the answer. I guess it depends on your society of what you want in the end. But that's the way I see it, at least. But Mehmet was very skeptical, so maybe I don't know. No, not at all.
Right. So, what do you think, Mehmet, about this?
I'm not skeptical. I was just having a thought that it's interesting because we are much less tolerant of machines than we are of people. If you have a loan officer and you provide him with certain information, and then the loan officer, based on that information, says yes or no, on a balance of interest, right? It might not be only a pure credit score, but there's a judgment call to be made at some point. Exactly. You can't explain it, but it's okay because it's a human being that's doing it, and so intimately you recognize the workings of the human being. If a machine reaches the same result, you want a much greater degree of understanding of exactly what the decision-making process was, even if ultimately we're talking about the same thing. Information goes in, there's a judgment call made based on a neural network rather than a human brain, and there's an output. But we're much less tolerant of the machine. It's just a sort of a random observation I was having while you were talking about the topic there. So no skepticism.
You've been working with many companies, so from the perspective of a legal practitioner, do you think that there is a one-size-fits-all sort of regulation? And what's the optimal regulation in your view?
Well, it's difficult, right? It's a bit of a question for a law student at the end of the day, because the very definition of regulation is that it's just it's supposed to be one size fits all, in the sense that you don't tailor regulation to the actors specifically. But you might want to still tailor it by sector. I mean, in the previous panel there was a discussion around that topic, whether things should be horizontal or whether there should be sector-specific regulations. I think that what's important for actors is to understand what's going on, and it becomes harder to explain to economic actors why a specific piece of legislation should be relevant to them if it reaches a level of abstraction which is too high. If you target a specific industry and you are responsive to the concerns of that industry and you're really talking the language of that industry, then regulation becomes more opaque, but it might actually be more understandable for the actors in that industry. There's a bit of a balance to be found there.
do you have anything to add from the perspective of your work on the CCPA? We know that CCPA impacts certain categories of firms. So what have we learned from the California Consumer and Protection Act on optimal regulation?
Yes. The CCPA affects only a certain number of firms, namely the ones that treat to some extent data of Californian residents, also firms only that are of a certain size. And the most important things that they do is they give the right to be informed about what data is collected, the ability to opt out of selling of data, and give you the right to demand the deletion of your data. Since then, there have been multiple amendments to make these laws stricter, more general, give the right to recourse, and so on and so on. So there's, if anything, there's a tendency to make it stricter. And of course, although this policy only affects firms that operate or like treat Californians as customers to a certain extent, this is a policy that affects many firms inside of California, outside of California, maybe even outside of the US. So with these things, you say, okay, maybe I will, I have the potential to deal with these customers, so I will also oblige these regulations. I think similarly to the global impact of the GDPR. What we have studied in our research project was the heterogeneous impact on different firms that have collected some data, firms that did not, showing that different kinds of regulation might affect these firms differently. So what we really emphasize is that for small tech startups, it might be necessary for them to provide them with data, to grant them access, to allow them to grow in the first place, to especially address concerns about competition, which became more serious recently, where we said, okay, these big tech companies are very entrenched. Should we do something to decrease their monopolistic power? And I think giving rise to new companies might actually achieve that.
Maybe I can add to that one point, and Mehmet mentioned sector-specific versus horizontal regulation, and I think another important aspect is this symmetric versus asymmetric regulation. And there we also see a difference between the regulatory frameworks and proposals we have out there. Because I think a big concern should be that we do not overburden new and smaller firms with this kind of regulation, which I think we currently doing, especially in the European Union in several contexts. And this is why I much more favor the approach taken in the Digital Markets Act, where the focus is really on a few very big firms that can probably also handle the bureaucracy that comes with it. And I think this is important to acknowledge also when it comes to privacy law. So when the GDPR was introduced, I think also many lawyers had this perspective that here it's about consumer protection and privacy, and this should apply for every firm, and we should not make a distinction whether it's a big or a small firm. And the outcome we kind of see is that it really has benefited the big firms. So if we look at the tracking market, the market concentration increased. Google acquired even more market shares. And of course, you can say from a privacy point of view, that may be fine because Google is complying with the law and it's very good in taking care of the data in terms of security. But whether it's really a privacy gain, I think is still debatable.
So Roxana, I want to briefly weigh in on this, and this is actually one thing as well where I had a slide that I just wanted to briefly bring up. Is that all right? So we've written as well about big tech and some of the reasons why big tech is so dominant, and I think that we've heard a little bit already about network effects and really also the effect of regulation, the fact that big techs are able to comply more easily with things like CCPA and GDPR. But I think more generally, I mean, this huge range of business lines creates these self-reinforcing loops. And the BIS has written about the data network activities or DNA feedback loop. So the fact that firms have a lot of data allows them to expand their network further. You know, Facebook has over 3 billion users. The Chinese big techs also have massive networks, Google, of course, Apple. And that network then allows them to, you know, introduce new ranges of activities, financial services, non-financial services, search, social media, you know, VR, all sorts of healthcare, cloud computing, really a very broad range of services. And that in turn gives them lots of different types of data on the same users. And this creates a competitive moat that no one can really cross. You know, there are really, really massive information advantages to a big tech like Google because they have access to your email account, your search history, your Android device, all of these different business lines. And if they have access to your checking account information and credit scoring, then I think you know, they really have you know, predictive analytics about you and your behavior that no one else would have access to. So I mean, I very much agree that, you know, DMA is a very good, valiant attempt to try to counteract some of this and to really focus on the big firms, make sure that they can't self-preference, you know, make sure that they can't push their own services to the top of the Google search and, you know, require vendors to you know, offer their products. But I think that in the end, you know, there are such powerful network effects, there are such powerful forces that are entrenching the big techs that I think there's a general question as to whether regulation can really do all that much. And even a big, you know, relatively important jurisdiction like the EU, you know, can only have so much impact on a global player like Google. So I think that there's going to be a lot more activity in this area. This is a very important policy issue, but I think that I agree with a lot of what's been said, and I think that regulation on the impact of the policy, sorry, research on the impact of the policies is a really important place to start.
So let me ask one last question, and then I'll give the mic to the floor in case the audience wants to ask some questions. So how should we regulate platforms? How should we regulate companies like Facebook and Amazon in the context where if it wasn't for them during the pandemic, I mean, they provided huge services. We are not depressed because we could all watch Netflix and we could all order food from home, so then we didn't get COVID. What are your thoughts on that?
Well, you know, others are depressed because they use Instagram, so I don't know. There's it goes both ways. I don't know. I mean, I use DuckDuckGo as a search engine, and it sucks. You know, I use it because I care about my privacy, but I have to go through like page 3 to, you know, when I Google academic web pages, if you give the name of the academic, DuckDuckGo spits out some conference programs where the person is listed, and it takes forever to get to the actual page. And so there's value in data, and you know, I don't want to get rid of that, certainly. But so I still think we can limit the blatant abuse of data in ways that don't disassemble or dismember those big techs, right? I mean, so if Instagram is employing psychologists to make kids addictive, I mean, we can certainly, you know, take care of that without splitting up Facebook. But I guess it's complicated because you need so many authorities to work together. And I mean, you mentioned that, you know, maybe finance isn't the right place, but at the same time, when Facebook introduced Diem, it took like 2 weeks for this to get, you know, stopped in its tracks by financial regulation. And I wonder why is that regulation so powerful? But in other areas, it takes us 5-10 years to basically, you know, get going on regulating things. So, I mean, maybe the finance guys are too powerful to regulate them, but I you know, it's possible, certainly, to stop things which are dangerous without making the company go away. And I guess the same goes for privacy and subcategories. So that, I don't know, that probably would be my approach here.
Daniel, please go ahead.
Yeah, maybe the question you posed is really a big one and the holy grail, probably, right? And I think a lot of what the European Union is doing at the moment or aiming at is precisely the question. what I think we should keep in mind is first that they are different platforms and they have characteristics which make them similar, but then also the markets are quite different. So for example, if you compare, let's say Amazon and Google search, then I would say there's much more still competition and competitors going on for Amazon, because in the general e-commerce space at least, whereas for search engines, the market is much more concentrated, right? But then on the other hand, we also have to ask what is the harm and what do we actually want to regulate, or what do we want to remedy? Because the special thing about the platforms are these indirect network effects, so bringing all of the different sides together. And from an economic perspective, we should then not forget that the platform itself, as an orchestrator of these ecosystems, has some good incentives in terms of the stakeholders that are at the platform. So this is different from a monopolist in a one-sided market. So that the platform operator has an interest in maximizing the pie, because usually he gets some percentage of this pie. So this is something that works in the right direction from a social point of view. And then I think, for example, with respect to search, but also other online platforms, the consumers are often the beneficiaries in many dimensions at least. So we can enjoy a lot of very interesting and helpful services. And I think where the focus should be is what is then on the other side. So often the losers are more on the business user side, that they are very small compared to the platform owner. And then if they even compete with the platform owner, there I think we get into the problems. And then especially if you look into a dynamic perspective, I think from a static welfare point of view, it's not so problematic. These markets work quite well. What we probably want to safeguard is diversity and competition in the long run. And this is also why I highlighted this niche entry and niche growth as a policy goal, which I think also goes in the direction of what John said. So the primary goal should be that we keep new markets open, and this bundling of different services, I think should very much be a policy focus, so that not every platform market that emerges as a new market will then again be dominated by one of the 5 familiar firms that we already have in the other markets. And what I see less as a goal is to really replace the dominant search engine by a competitor. I share the skepticism that this is probably less feasible, but we then can have targeted regulation to tackle the problems we see there.
Do we have a question from the audience? So maybe,
Thank you. So I have a question. I'm working as a data scientist for the Swiss Post, so I have a lot to do with the technology part and also with GDPR and the discussion. And also, like you mentioned it many times, like this black box where people talking about this is AI. And so every project is kind of the discussion with the trust issue. Like, I mean, everybody is, has their smartphones now. They are doing a lot of things that I would probably not do, but that I want to run a linear regression on the finance reporting stuff. And then I have the discussion like, this is AI, like you are doing weird stuff that I can't understand and we can't trust it. Like, this is probably the short-term issues, and then we have the long-term revenues of AI. I see this point is quite probably going over time less and less and less. But what is your estimation? Like, when are probably the people in the regulation, people who are deciding about regulation in the politicians, when are the CEOs, like, when do they all know what is in the black box? I don't know if they have to be really deep dive what is AI and what is a deep learning model, but like a bit more technology perspective or mathematical understanding, like what is behind, and not the discussion about a huge black box that is scary, that I can't trust. Like, I would really like to have an estimation like 2 years, 10 years, 20 years? Like, what's your opinion? How long do I have to be really patient with all my environment?
I'll take this one. You're going to have to be very patient for a very, 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 very long time. I mean, that's my personal opinion. I am extremely frustrated as a human being because the age during which we had our so-called Renaissance men or women, as the case may be, polymath people who were capable of having a grasp of multiple areas of science, whether it's physical, social sciences or other, that age, as far as I know it, is now over. Leonardo da Vinci had a broad grasp of all sorts of sciences of his age. It is no longer realistic today for anyone, other than as a passing interest, to pretend to have the grasp that he had of the sciences of his age in the age that we are living today. And it's only gotten worse in the sense that even sector by sector, it's no longer possible for a subject matter expert to pretend to have a broad understanding of all of the sub-areas within the sector they work in. I mean, I'll speak for myself, and then scientists in the room, I can think of their areas of activity. So I'm a law practitioner. I'm specialized in corporate law. More specifically, I'm specialized in venture capital and private equity financing rounds. I have an idea of what tax is because I have to fill out a form and pay it. I know there is VAT. I know that there is a tax department somewhere in a law firm that deals with this, so I don't have to. I will send out emails to people saying I have no idea how this works. Within a tax department, there is someone who deals with VAT, and within the VAT department, there is someone who will deal with the type of VAT which is applicable specifically to cross-border services. And this is not even science. This is just, you know, human beings making stuff up for themselves. Now, the way I understand how machine learning works these days and how artificial intelligence works is that every person across the chain might have a very good grasp of how a very specific part of the tool functions. Someone can code a machine learning function in one way or another, but that same person is highly unlikely to know exactly how the transistors in the computer actually function. You know, it's a global whole. All of this to say that the normal human being, who is not intimately interested in how machine learning works, has no chance, as a matter of general culture, of reaching a level of understanding of what is in the black box and how it functions, which will be sufficient to reassure him on a deep level of trust that this is okay. He will always be moving the trust to another level and saying, I trust someone else to have done this review for me and to have checked what is going on there. And so we displace trust on someone else. And currently, the issue, as you mentioned, is really one of trust. We do not trust our shadowy overlords, or whatever we call them, Google, Facebook. You know, we do not identify these on some level as worthy of trust in the same way as we identify an old banking institution as worthy of trust. It's a matter of image. Perhaps it's because banks have been around for longer, who knows? But it's not as simple as reaching a level of understanding of the technology. That's not going to happen in any way. It's really reaching a level of trust in an entire industry, which is new, the way I see it. But, you know.
Brief comment, and then we all go to dinner.
I'll be very brief. So I think it's a two-way street, right? So I mean, the reason why it's easier for me at the BIS to talk to bankers is because we speak the same language, because we grew organically for 100 years. So I could ask you, why don't you explain better to me what you're doing, you know? So I get it, when I understand it, maybe I'm okay. And so I think we need to, I mean, it doesn't happen quickly, but I guess we need to both, you know, take a step in the same direction to speak the same language. So when Richard Feynman, I think, explained the Apollo disaster, he had a glass of water and a little, you know, ball he threw into it, and that explained how whatever the fuel leaked. Shoot me. But the point is, you know, he explained simply to a judge what happened in the Apollo, and then the judge said, well, that makes sense. Okay, so that guy's guilty. Like, it's very simplifying drastically here. But so, I mean, you know, it's technologists on one end and people who come more from, I guess, finance, law background. So we need to speak to each other, but it goes both ways.
Thank you so much. This was really interesting. So thank you to the participants. Let's give them a big round of applause. And I wish you all a good evening.
Thanks a lot. I've enjoyed being a talking head. Have a good evening.
Yeah, thank you. Enjoy the dinner. Would love to be there.
Thank you so much, guys. I will close the Zoom now. Have a good evening.
Great.
Thanks so much for all your great comments.
Thank you. Bye-bye.
Bye.
Bye-bye. It's there.